Paying taxes sucks, and here's something most people don't realize. In many countries, you can live in a specific way, stop being a tax resident, and still keep your passport. You don't have to renounce, you don't have to disappear, you just have to do it correctly. Today I want to walk you through the logic behind it, using Australia as the main example, because Australians are dealing with this a lot right now. But if you're watching from Canada, Germany, Spain, the UK, anywhere with high taxes and growing rules, the concept is the same. How do you live properly? What traps do you need to avoid? And what does a real plan B actually look like? Let's break it down. It's not always politics, sometimes it's just the vibe. Uncertainty, global events, rules changing faster than people expected. And the pattern is simple. People want options. They want to be able to live somewhere else if needed. They want to reduce taxes legally. They want to protect their business, their banking, and their family. But the biggest mistake is this. People think it's just about moving countries. It's not. It's about changing your center of life. Your passport is your citizenship. Tax residency is a separate thing. In most countries, Australia included, the government doesn't tax you forever just because you are a citizen. They tax you because they say you are still a resident for tax purposes. So the real question isn't, where do I want to go? The real question is, how do I stop being a tax resident in my home country? And different countries have different wording, but most of them look at the same core factors. Think of it like 3 tests. Where do you actually live? Meaning, where do you spend your time? Where's your family? Where are your assets? Where's your business? Where's your day-to-day life? This is what many authorities call your center of life test. And then secondly, where is your permanent home? Even if you travel a lot, if your real home is still clearly in your home country, it's hard to argue you left. And then 30 is a day count rule. This is where people mess up. They hear something like 183 days and assume that's the whole story. It's not. In Australia, 183 days can matter, but it's not the magic cheat code. Because if your whole life is still based in Australia, then spending 6 months in Bali doesn't suddenly make you a non-resident. That doesn't fly. The real shift is move your life out, then visit Australia, not the other way around. For Australia specifically, the tax year runs from July 1st to June 30. So day count planning has to match that calendar. So if someone truly wants to break tax residency, it usually means doing some real-world moves. Not just traveling, but things like selling or renting out the family home, moving your main banking activity abroad, shifting where your business runs from, building real ties in a new country, documenting the change properly, and following the compliance steps your home country requires. And yes, there are forms, notifications, and technical details. And that's why it's not a DIY YouTube hack. The principles are simple, but the execution is what gets people in trouble. Because most countries are getting stricter. Australia is a perfect example. There have been discussions about reforms that would make tax residency more sticky, meaning harder to break, including proposals that could reduce how much time you are allowed to spend back in Australia before you get pulled back into tax residency. Not all of those changes have become law, but the direction is obvious, and that's a broader trend globally. Governments don't like losing taxpayers. So if you're thinking about leaving, you don't want to wait until the rules tighten. So if you are an online business owner, one structure comes up and up again. US LLCs. Not because the US is low tax for everyone, it depends, but because the LLC structure can be extremely flexible when used correctly in a global plan. Your company structure and your personal tax residency are 2 different layers. You might still have taxes on local income in Australia. You might still have taxes on certain assets, but you can potentially separate your personal tax life from your home country, if you structure things correctly. And every case is unique, that's why planning matters. The first mistake is thinking you can half leave. The second mistake is moving everything from one basket into one new basket. Example, someone leaves Australia, moves to Dubai, and then puts all their banking in Dubai. Now everything is still dependent on one country. That kind of defeats the purpose, so a stronger approach is diversification. This is why people often look at Singapore or Hong Kong, meaning higher minimums, more traditional private banking, Georgia, popular for simpler personal banking setups, and US banking access through a business structure, and other jurisdictions depending on comfort level and deposit size. The goal is simple: have access to fiat systems, have access to multiple banks, and reduce your dependency on one single country. Even if the tax strategy is perfect, if your family hates it, you won't last. This is why just move to X advice is usually garbage. Because people have parents, kids, schools, businesses, relationships, and health needs. And places change. A lot of people have an old picture in their head of places like Bali, and they arrive and realize it's not the same as it was 10 years ago. So the best approach is not emotional relocation, it's a blueprint. Make assumptions, visit, validate the assumptions. Schooling, healthcare, daily life, safety, infrastructure, how it actually feels. Planning reduces false starts. If you want to stop paying high taxes legally, you don't need fantasy, you need structure. Understand your home country's residency rules, move your center of life, build a new base in a tax-friendly country, diversify banking and assets, and execute it correctly. And if you want help with building and executing a real plan B, including international structures, banking, and a proper step-by-step strategy, you can reach out through the link in the description. Because the biggest cost isn't taxes, the biggest cost is doing this wrong. I hope you enjoyed the video. Leave it a thumbs up, subscribe to our channel. See you in the next one. Bye.